Hello, everyone. It's Make a Move Mike, the Veterans Realtor of Realty Executives Dylan. I'm here with Andy Cruz of Mortgage Heroes, and today we're going to be discussing 5 different types of mortgage loans. Now, you're asking why we're going to discuss just 5 or why we're discussing 5. Well, one mortgage loan does not fit every borrower. So everyone has different financial needs and goals. And different goals, excuse me. So the first one I'm going to discuss is the conventional mortgage. That one's probably the most common here throughout the U.S., including San Diego, of course. So with that conventional loan, typically you can get a conventional loan with just 5% down. And from my experience, conventional loans generally have a little bit more purchasing powers in certain markets. And in this most recent market, conventional loan was probably leading the pack because
well, part of it is just there's a lot more of them percentage-wise. When you look at the entire county and how many houses are sold, the majority of those are sold to conventional loans because that's what most of the public is. They're private citizens. They're not service members getting VA. They're not first-time home buyers necessarily using FHA. So especially in a market like this where the price point is a little bit higher.
Yes.
And the other thing is it's also what is most widely made available through your institutional banks and your normal lenders. So someone's talking B of A, Wells Fargo.
Right.
Even the USAAs and the Navy Fed, people think, oh, that's VA only. It's not VA only.
Yes.
They have conventional. It's just that their pricing is very, very unfavorable for conventional. But it is also just very common because it's prevalent, but it's for just percentage-wise. And there's also a stigma. To be honest, I mean, to be candid, there's sometimes seller agents who don't know better. You do because you're familiar with VA. A lot of selling agents, they're scared about what they are unaware of or what they're unfamiliar with. So conventional financing, it's the same price as the VA. Well, that's going to be less trouble. That's not necessarily true at all. Yeah. I mean, you could think the loan process is less troublesome, but what if the borrower isn't as greatly qualified or strongly qualified as the VA person? Yeah. So I know we're going to get into VA, but that's just an example of where, conventional is very prevalent, but it's not the end-all be-all for everybody.
Got it. Great information, guys. So the number 2 second loan we're going to discuss is FHA, the Federal Housing Administration Loan. It's a government loan, less stringent qualifications. And what I mean by that, there's lower credit requirements, lower credit score requirements, I should say. Lower down payment of about 3.5%. You do have PMI, which is private mortgage insurance, and that basically insures and protects the lender in case of a borrower defaulting on the loan. Yeah. For those of you thinking about the PMI and how to get rid of it, well, you're going to have to refinance to get out of it. And as Andy was just telling me, PMI is usually, or not usually, it's always there when you have 80%.
Less than 20% equity.
Less than 20% equity in your home from when you originated the loan with your lender.
There is one trick though. If you have an FHA loan long enough and you've paid down your balance to less than 80% of your starting balance, then you can call and have them remove it because the threat isn't there anymore. So it's this weird way that private mortgage insurance works. So it's basically an insurance policy that is the bank's insurance policy against you in case you default, but you make the premium payment for it. So it's like someone having a life insurance policy that they get the death benefit from, but you're making the premium payment. It's exactly like that. Now, the 2 ways like we're talking about right now, number 1, you can refinance and just go into a conventional loan. If you have 20% equity in your house because the market has raised significantly in appreciation of value like it has now, get out of your FHA loan by refinancing. Go into conventional. Your mortgage insurance, boom, goes away. That could be $200, $300, $400 a month in some cases, especially in these types of neighborhoods in San Diego. Now, if that's not eligible for you right now, you don't have enough equity, keep paying down that balance. And eventually, when your current loan balance is less than 80% of the starting balance, then you can just call them and say, hey, remove my mortgage insurance, and they have to do it.
Gotcha. And the next one, VA loans, which, Mortgage Heroes does a lot of those. It's 0 down for the VA loan. You do have to have closing costs. I want to make sure everyone knows that because a lot of people that I've come in contact, still to this day, I've been licensed for just under 11 years, and everyone still believes that there's no closing cost to be paid by the veteran when they purchase a home using their VA loan entitlement. So I want to make sure everyone knows that. But in addition to the closing cost, there's also can be a funding fee if you're not exempt from it.
Right.
The funding fee is another It's similar to the FHA mortgage loan, where it insures the borrower, or excuse me, it insures the lender in the case of the borrower defaulting on the loan.
Right.
So, and I know in recent years there have been a release on the VA loan limits, and they've shot up. There's still what do you put it?
The banks have put their own limits where there may not be a VA limit anymore. Banks are still the ones lending the money. So they'll set the boundary for how far they're going to go based on their own tolerance for underwriting and their own tolerance for lending to people. Right. So while it's the VA that's still issuing a partial guarantee to backstop the bank's investment of giving you, the borrower, money as a veteran or active duty member, it's still to their own discretion how much they're going to lend to people based on a variety of issues. Number one is the price points in a certain area, the type of property matters, whether it's a single family home, attached, detached, condo, high rise, low rise, multi-unit, 2, 3, 4 unit. Like there's all these variables. Yeah. Oh, and then you get to the borrower. Then you get to the credit score, money down or not, first time use, subsequent use. There's all sorts of metrics that go into that.
Yes. Now, I remember there used to be a stipulation where you had to put 25% down. The difference between the VA loan limit and the home that you're purchasing, if it was over that limit.
That's correct. That was when there was the county loan limit.
So that no longer applies.
Right. But again, now back to the banks having their own discretion at how much they're going to lend and what the requirements are going to be. That's more of a case-by-case basis now. Or at least that's what we're seeing. More of a case-by-case basis with our own banking line and with the other outlets that we have.
Yes.
There's much more variety now because the marketplace also knows something, that VA loans have the lowest default rate of every other loan type across the country. Yeah. So in the bank's mind, they're like, well, hold on a second. We need to free up more cash to lend to these people because they pay and there's a low default rate. Yeah. So as a bank and institution, they're like, well, that's how they make money, is by collecting interest and issuing loans. So just from a mechanical, technical perspective, them opening up the cash box to give more VA loans works ultimately in their advantage, much more now than it had in the past, because people just were leery of it. VA wasn't widely known. There was a huge lack of education around VA for a long time, and it was just very much underused and just untrusted by a lot of people, and it shouldn't have been, but it was, and we're in a different time now. But you're going to see it for that reason too. Banks know that they're going to be able to lend out money for VA and get those payments on time and have a very low default rate.
Yeah, and what I found from my experience on active duty is, by talking with a lot of people that I served with while serving with them, a lot of us were either misinformed or uninformed.
Yes.
And that clouded our judgment, and that kind of created a stigma where no one wanted to use their VA loan. And I even saw in the real estate industry, a lot of professionals did not want to deal with VA. Yeah. Now everyone's realizing the benefit and the value of having VA entitlements or VA loans, and like Andy mentioned, how we're the least likely to default on a loan. Right. I say we because I'm a veteran. Yeah. I have my mortgage on a VA loan myself. So I think people kind of wised up and realized the value of it, and now it's probably one of the most used loans for those who are able to take advantage of that opportunity.
And I think it's important to say, like, I don't think people did that with any ill intent. I don't think it was to manipulate or, to create distrust in it. I just think that, people, when you talk in your friend circles and your friend who you trust knows something, but it's wrong, they know it, so they know something that's wrong, they share it, now more people know the wrong thing.
Yes.
But because it came from a trusted source, we just believed it. Yeah. This happens a lot when people go, I didn't know I could use my VA entitlement more than once. So like, it just has to be renewed. We just had to restore your eligibility. Yes. So we've had so many people that like their whole life of owning real estate has changed because that one simple thing that they thought, one-time use only, single-time use, it was not untrue. But they believed it to be untrue, not of any fault of their own, not of any fault of someone else. It was just bad information passed from person A to B to C to D, and then led that person at the end just not to take advantage of the full benefit.
Right. So to Andy's point, I want to say if you're receiving information from anyone, and even though you may be trusting it, just verify, and you can verify with the mortgage professional or someone within the real estate industry who can help you out. So keep that in mind, everyone. So number 4, the fourth type of mortgage loan I want to discuss is renovation financing. You can purchase a home that needs renovations, of course, and finance the cost of the renovations with an FHA 203K loan. These loans are not really used often because they don't have that purchasing power like other loans, and they're not competitive in certain markets, specifically a seller's market like the one we're in right now. It's shifting a little bit moderately, but it's still not the ideal market for an FHA 203K.
Well, some situations warrant it, and some situations don't. If you're walking into a nice house like this, and the roof is intact and it doesn't leak, and the foundations didn't crack, like it's a good, stable, well-kept house, then there's no need for an FHA 203K rehabilitation loan. If it's a house that needs rehabilitation, then that's where an FHA 203K loan could come into play. But typically the seller knows that, and so does the listing agent.
Yes.
Where it tends to be a little bit difficult is when someone who is qualifying as a buyer for a 203K loan, they go into a place thinking it may need more work than it does, and the seller disagrees. That's where there's some gap between what we think is going on at this place and what actually is going on in this place. And so it really has a lot to do with the availability of such type homes that would require 203K to begin with. That's where there's prevalence, is when the market bottoms out and the houses are just dilapidated and a bunch of them need to be fixed at once. Then you got to go with the 203K, where you're buying it for X amount of price, and a certain part of that money is escrowed to pay for construction rehabilitation costs along the way. But they're just not real prevalent right now because there's so many homes that are just well kept that there's not a need for them.
Yeah, and I think, to your point, I think one of the things about FHA 203Ks that I always liked is that they fund you fund you and finance you based on the after repair value.
Correct.
What that home is going to be worth after you've made all the renovations.
Yeah, coupled with current costs.
Right.
So it's current labor costs, current material costs with future value once completed.
Right.
So that formula then generates what that amount is going to be.
So I always thought that was awesome.
Yeah. And the reason this is important, for us right now, just keep your eyes open, because as much as I'm saying there just aren't a lot of them right now, there are plenty of homes that are being bought up by investors for cash that they're fixing, and they're putting back on the market as long-term rentals or Airbnb, VRBO. Right. But when the investor appetite changes and there's still homes that need to be repaired, the FHA 203K is going to make a little bit of a resurgence in the comeback. I'm calling it right now.
Nice.
I'm calling it now.
You heard it right here.
And the last one we're going to talk about today is the jumbo loan. So this is a non-conforming loan. So Mike and I in the beginning of this video talked about conventional financing, and conventional financing has conforming and non-conforming. So conforming means up to a certain loan limit. Non-conforming means above that loan limit. Jumbo equals non-conforming, which is above the conforming loan limit. So that number gets changed every year, and so the term jumbo actually kind of has a varying definition every single year when that number gets changed. And you will typically see it in your more higher priced, more expensive areas. Some places like San Diego that just have a lot of neighborhoods that are valued and appraised very high will have a disproportionate amount of jumbo financing, simply because it's just the nature of it. It's just the technical nature of it. The way to avoid jumbo financing is just put more money down. So if you're buying $1 million house and you have enough money to put down a substantial amount that would bring your loan under the conforming limit, then you're out of jumbo financing. But for those of you where you have a fixed amount of down payment, jumbo financing might be the way to go. The rates are a little bit different, but it's not because the loan amount is higher. This is a myth I wanted to talk about today. A lot of times people go, oh, what's a jumbo loan? So the rate's higher because of that. No, it's not higher just because the rate isn't higher because the loan amount's higher. The rate is higher because the pool of money available is lower. It's less. So if you think of supply and demand, when there's a lot of something available, it's usually pretty cheap to get. Right? When there's scarcity of something, it's more expensive. So if I have a pool of money over here for conforming loans, and it's $1 trillion, I can offer that money at a lower rate. But if I have a pool of jumbo loan money that's only $1 billion. That's way less. There's scarcity in that. I have to charge more because there's less of it for me to lend out. So in order to get the return I need to charge a higher rate. That is what makes jumbo loans higher. The common misperception for our entire career has been, oh, well, it's because it's a more expensive house that the rate's higher. Nope. You could have an 800 credit score and your rate will be different in the jumbo loan than conforming, specifically because the pool of money that you're being lent from is smaller.
Great information, everyone. Those are the 5 mortgage loans that we discussed today. If you have any questions or concerns, or just want to find out more details, in-depth details about each of these loans, Mortgage Heroes offers each of these loan products, and we're happy to discuss with you or have a consultation with you. I can help connect you with them if need be, but I want to thank you again for being with us here today. And if you have any questions about buying or selling a home or refinancing or obtaining a mortgage, please don't hesitate to contact us via phone, text, drop a comment below, direct message, or however way you choose to communicate. We'd be happy to hear from you. But thank you again for being with us, and have a great weekend.